How's everybody doing today? We're in week 4. We're making progress. Unfortunately, I'm still without a quality cheeseburger to my name for this semester. Seabreeze was closed the entire weekend. So I know if that's the worst problem I face in my life, that's a pretty good life. Quick note before we get started. If you have not already, please make sure you take a look at your homework submissions to make sure there's any notes, you're not missing anything. We've got until next week on Wednesday to get everything sorted. After that, whatever your grade is in home or grade for homework is online, that is your final grade for that particular item. Once we start moving into other items for the semester, I will expect you to have gotten the routine down and have the submissions down. I'm pretty lenient with the first for the first exam to make sure that everybody gets the routine down, understands what they need to be doing. But my expectation is that we'll get all that fall moving forward. There were a few issues with the homework this time around, but again, that's not a big deal as long as you take a look and get it right. All right, today we're doing what I personally believe is the most important chapter in the entire course, the most important lecture in the entire course, I should say. What I would strongly recommend as we're going through this, take diligent notes, particularly on the things that you're having trouble following, and ask questions if you're don't understand something. Refer back to these notes if you think that you've got questions and issues. We will be talking about these concepts throughout the semester, but it's really important to have a strong foundation. If you miss something in the notes, refer back to the lecture video on YouTube. Again, having all this information is going to be really important. This is the core foundation of testing and auditing. And so since auditing is basically a big part of testing, we need to understand what it is, the concepts that are related to the testing of testing and auditing. So let's go ahead and kick off. There's going to be a lot of information. Just for context, whenever I go through detailed lists, everybody assumes that I'm expecting memorization. And I want to tell you right now, these lists we're going to go through today, memorization is not sufficient. If you memorize all the names, you're still going to struggle on the exams. Whenever there's a big long list of something, my expectation is to hit knowledge level of competence, which means that not only can you list all the items off, but you can explain to me in detail what all these items mean. There will be some activities to help reinforce this. We're going to have part of that our discussion on Wednesday, but there's going to be 2 distinct lists in this particular lecture. And when I go through these, I don't expect you to be able to regurgitate them back to me. That's not what I'm going to ask you in the exam. What I'm going to ask you is detailed questions on each of these concepts. So you need to understand them at a very, very in-depth level. So what is the first thing? This is one of the things that we talked about in our first lecture. It's called management assertions, which we have some experience to. Remember that information that's presented either through transactions and events or account balances is a representation made by company management. Basically one of these concepts that we're about to go through. So the example that we looked at is we looked at inventory. We said inventory both exists and is valued properly. So those are assertions being represented with respect to that particular account. So we're going to go through the list and then we're going to go through the definition of each of these. Now, keep in mind here that these can be represented at 2 different levels. These can be represented whether we're talking about day-to-day operations of the organization, which is going to be transactions and events, or these can be represented in the financial statement presentation, which would be account balances. A lot of these will overlap both of them, but not always. So we need to make a distinction between what they relate to. All right, so when I say assertions in this course, I'm generally referring to this. I may refer to them as audit assertions. I may say management assertions. I may just say assertions. From this point forward, whenever you hear the term assertion in this course, you should not think that it's common or vernacular assertion, but it's me referring to one of these specific items. All right. The first 3 are going to be the most important for you to know. That's going to be completeness, existence, occurrence, and valuation, allocation, accuracy. I'm going to go through these quick right now because I'm going to go through each of them in detail here in just a second. Okay. Then we have, so these are what I call the 3 most critical assertions. These are going to relate to about 75% of the questions that we're going to deal with related to assertions in this course. Then we have something called rights and obligations. Then we have presentation and disclosure. The reason I put and disclosure in there is in the book it's referred to as presentation, but by the PCAOB guidelines, they actually call it presentation and disclosure, which by definition, presentation relates to the disclosure of information in financial statements. So it's kind of redundant. But anyway, so PCAOB assertion, and the reason it says PCAOB is this is recognized by the Public Company Accounting Oversight Board, but not by the Audit Standards Board. 2 that are recognized by the Audit Standard Board are classification and cutoff. Classification is very similar in concept to presentation, slightly different. cutoff is going to be something that's will be unique and distinct. But both of those are auditing standards, board assertions. You won't need to make too big a distinction about which set of standards these relate to. I'm more concerned that you understand what they represent conceptually, what those mean. So I would think about those in that concept, but more about what they represent as a whole. When I ask you questions, I'm going to expect you to know these assertions. The final one, I want to throw a caveat on in here. I think I mentioned this back in the first lecture. This final one is not really assertion. It's listed here because the book, the authors Messier, Glover, and Pratt, MGP, continue to put it in the book as an assertion. It has not been a financial statement assertion for like 20 years, but they continue to throw it up there to conceptualize because it used to be a financial statement assertion. I will not ask any questions on the exam about it, but the only reason I include it in the slides is you may see it come up in your homework or in your reading. So it's not really an assertion. Authorization is important, but that's more about controls rather than assertions themselves. So let's go ahead and talk about these at length. Let's talk about what these represent. So the first one is called completeness, all right? And completeness has basically two different perspectives, okay? Or two related perspectives, I should say. The first one is that all transactions or events have been recorded. Full stop, okay? They have been recorded. Now, the reason I say full stop is because we're going to have multiple assertions that relate to recording of information. But some of these are going to relate to whether they've been recorded at appropriate amounts or whether they've been recorded during the proper period. So when we think about completeness, we're asking, did something get recorded? So think about it this way. A shipment of merchandise came to your docks. You know that that shipment is there. You can see the inventory. It's right there in front of you. Did this shipment get recorded in the accounting system? That's what completeness is asking. If the answer is no, it's said to violate completeness. That's the idea. Same holds true when we think about account balances. All ending balances for balance sheet accounts that should have been included in the financial statements have been included in the financial statements. That's the concepts we have there. So I want to make a few notes about completeness, and some of these are not going to make sense right now, but they will make a lot more sense a little bit later on. All right. So first of all, I want to make a note here that completeness is a critical assertion for liabilities and expense accounts. And to a lesser extent, equity accounts, though we don't see that as much. So liabilities and expense accounts and equity to a lesser extent. Generally speaking, when we look at accounts of these types, we are very concerned about whether transactions are complete. And it makes intuitive sense if you think about it. If you're an organization, do you have an interest in overstating your expenses or understating your expenses? Understating, because that's how you increase income, okay? So we as auditors want to make sure that expenses are fully reported. Same thing for liabilities and equity to a lesser extent. Also, make a note here that completeness is a directional assertion, and it moves bottom to top. Now, what I mean by that is when we test completeness, we are going to start with the source information or the source documents. So we might start with invoices or receiving reports, and we're going to move up to the accounting system, the accounting records. So when I say it's a directional assertion, I mean that we're moving from source to record. That's how you have to think about it. The source is a foundation, it's the bottom, and the records, the accounting information, that's kind of the end result that's at the top. It doesn't make any sense right now, but it will make a little bit more in context. Completeness is a directional assertion, bottom to top. And there will be an easy way to remember that. We'll get to that here in just a little bit. All right. So now let's talk about the second assertion. And I want you to think about this second assertion as the opposite of completeness. This is called existence occurrence. Okay, existence occurrence. Existence occurrence basically says that we know something is in the system. We know it's been recorded. Can we find proof of its existence? And we've already used this as an example for inventory. Can we find proof of its existence or its occurrences that took place? All right. So all transactions and events that are actually occurred and pertain to the entity, and all ending balances for balance sheet accounts that have been included in the financial statements actually exist. So with completeness, we were concerned that something that exists actually got recorded. So the inventory that's on our floor, did it go into the records? For existence occurrence, it's the opposite. Something we can see in the records, can we find evidence of its existence? So if these are opposite, what direction do you think this moves? So top to bottom for this one, okay? So bottom to top for completeness, and we're moving top to bottom from here. We started with the records, and we moved down to the source. Also, remember how I said completeness was a critical assertion for liabilities and expenses? Existence occurrence is a critical assertion for assets and revenues. Those other accounts, yes, assets and revenues, which again makes sense if you think about it. If you're an organization, are you more incentivized to overstate or understate your revenues? Yeah, overstate your revenues because you're trying to make income. So we as auditors want to make sure if there's a revenue account being represented that we can find evidence of its existence. So these two are contrary to one another. They move in different directions. They're basically opposites of one another, but they're both very important, and these both can be looked at simultaneously in certain circumstances. All right, one of the three most important ones, the last one, is going to be valuation allocation accuracy. This one is kind of as it sounds. This one's not particularly confusing to understand. That's all amounts that have been transactions and events have been recorded appropriately, and all ending balances and adjustments for balance sheet accounts have been included in the financial statements have been recorded at their appropriate amounts. So amounts are properly valued, items that need to be allocated have been done so appropriately, and everything is accurate. Now you will notice that this is also a recording assertion, but this is not saying did something get recorded. This is saying did something get recorded correctly? Did it get recorded at the appropriate amounts for the proper values? So you think about it, it's very similar to completeness in the fact that they're both recording assertions, but they're asking different questions. Now, unlike completeness and existence occurrence, valuation allocation accuracy is generally relevant to any account. Any account is just going to be relevant to valuation allocation accuracy. Because numbers can be misstated and numbers are the foundation of accounting. All right, so with respect to that, I want to make a quick note of this before I move forward. You may have noticed that in all three of these situations that I gave you 2 bullet points. So the first bullet point related to transactions and events, day-to-day operations of the organization. Second bullet point related to account balances, what's in the financial statements. So all three of these assertions relate to both transactions and events and account balances. The reason this is important is because the very next assertion will only have 1 bullet point. Actually, it's got 3 bullet points, but it's technically 1 bullet point with 2 subpoints, okay? So there's only going to be 1 main bullet point, and the reason why is because it only relates to one of these categories. This is called rights and obligations, okay? Now, rights and obligations is saying that for balance sheet accounts with ending balances recorded in the financial statements, the entity holds or controls the rights to assets included in the financial statements, and that all liabilities are obligations of the entity. To shorten this, it's basically saying if something's recorded as an asset in the financial statements, then it should be a legitimate asset that the entity has rights to recognize. So has anybody heard the term factoring of receivables before? Does that come up in your financial accounting classes? So it's not really commonplace anymore, but it still used to be fairly common that companies would sell their receivables to other companies for them to collect. They would do so at a discount so they could actually gain cash for operations. If you sell your receivables to a third party, you no longer have the right to collect those receivables. It's no longer an asset on your financials. So factoring receivables basically means you no longer own the receivable. You no longer have the right to recognize it. Same thing for liabilities. If you paid off a liability, it's no longer an obligation to the entity, so you no longer record it in the financial statements. And again, just I pointed out, you will notice this only relates to ending balances. This is because this only relates to information in the financial statements. We don't concern ourselves with rights and obligations related to transactions and events. All right, let's move forward. For some reason, I transposed the order of these and I've never fixed it, but the next one I'm going to talk about is classification. Remember, this is an auditing standards board assertion, but all transactions and events have been recorded in the proper accounts and all account balances have been recorded in the proper accounts. So we have another recording assertion, but this is saying, did something get recognized in proper accounts? Now, this seems like a really, really minor one. It says, well, who cares? As long as it's in a generally correct account, Dr. Barnes, we don't care that much. Remember, we talked a little bit about debt covenants a little bit earlier in the semester. We said organizations may fall in violation of debt covenants. One of the big debt covenants that organizations are generally held to is liquidity ratios, such as current ratio. So current ratio is current assets over current liabilities. Remember that from 221? Is it possible to manipulate that through classification shifting? Very, very possible. In fact, it happens all the time. So we as auditors need to be conscientious of that and saying, are they recognizing too many current assets? Or are they recognizing not enough current liabilities? Are they shifting items to different accounts simply because they want to maintain those ratios? Related to classification is the PCOB assertion, presentation. Presentation says all transactions and events have been clearly presented and disclosed, and all ending balances have been clearly presented and disclosed. Now, this is generally going to be more emphasis on the latter, ending balances. That being said, there are definitely transactions and events that do need to be included in the financial statements. A good example of these are those related party transactions we talked about back in chapter 3. All related party transactions do need to be disclosed in financial statements, or at least the category, at least the general nature of the related party transactions. So that would be an example of presentation disclosure that's relating to transactions and events. All right, our final real assertion is going to be cutoff. All right. Now you may notice cutoff only has one bullet point, and that's because it only relates to transactions and events, but it says all transactions and events have been recorded in the correct accounting period. Now cutoff is interesting because it only relates to one assertion area, one assertion category, but it's a heavy emphasis in that area, and it's one of those areas that's rife for fraud. If you think about it, if you are a fraudster and you're trying to up your numbers for the end of the period, could you shift forward sales that occurred into a previous period to recognize them in the current period, or sorry, in the future period, in the current period? Like say, for example, I'm going to recognize my January 1st and January 2nd sales on December 31st. Yes, that's happened quite a bit, okay? That's happened quite a bit in the past, which is why cutoff is such a big concern for assertion for us as auditors. We want to make sure that transactions are recorded in the proper period. All right, this last one, you can basically ignore this one because I will never ask you a question about authorizations related to assertion, but I want to make sure that we talk about it since it is in the book. Authorization, you will respect my authority. All right, all recorded transactions and events will have been properly authorized. Now, this is not really a management assertion anymore, but it is going to be something that's relevant to us and something you may encounter. All right, everybody on board? Everybody got that down? Ready to take an exam on this stuff? Probably not. All right, that's fine. That's fine. That's kind of the framework we're going to operate from, but we're going to talk a little bit more in detail about that. So let's go ahead and burn through the next few points before we get to our next list. All right. So here's a list of the management assertions, and you can actually look at either one of these to get an understanding of which ones relate to transaction events and which ones relate to account balances. The most important thing to remember with respect to these assertions is the way they behave when we're talking about one category of assertions is different from the way they behave when we're talking about a second category of assertions. So first of all, when we talk about these assertions at a general level, the transactions and event assertions are basically all assertions except for rights and obligations, which is much easier to remember than an entire list of those. So if you know the assertions, then remember the rights and obligations is the only assertion that doesn't relate to transactions and events. As far as account balances, the only assertion or assertions, depending on your definition, that don't relate to account balances are cutoff and authorization, which again is not really an assertion. So what does that mean? It means that when we're talking about testing for transaction events, we're concerned about what's happening with daily operations, what's happening with transactions that flow through the entity. When we're talking about testing assertions for account balances, we're concerned about what is the entity representing in its final position within the financial statements. The numbers that are being reported in the financials, are those materially correct? Now, how is that different? Well, one big difference is where we test them as part of the audit. So does anybody remember way back in the day, way back several weeks ago when we were in week 1, and I told you to write down test of controls only relates to transactions and events? Like, I barely remember that, Dr. Barnes, because, well, I don't pay attention a lot to what you say. I'm joking. No, but it's fair that you don't remember that because that was like 3 weeks ago, okay? It was like 3 weeks ago. So one of the things that we know about controls is controls are basically dictating the flow of transactions and events through the organization. And so when we think about assertions that are related to the controls, we're going to be focused on the assertions that relate to transactions and events. More to the point, we're also going to be focused on tests, types of evidence that focus on transactions and events. So there's going to be a distinct overlap that we're going to talk about. Now, we haven't gotten to audit evidence yet, but we'll get to that here in just a second. Most important takeaway right now is to remember that when we talk about controls, we're talking about assertions related to transactions and events. That's ultimately what we're trying to test. When we talk about account balances, again, we're talking about year-end reporting, and that usually takes place during substantive testing. So an example of testing for accounts receivable might be, we look at management assertions of existence, rights and obligations, completeness, and accuracy evaluation. Now, the reason I bring this slide up is that it's not so much important to understand what assertions are being tested, but how do we test those assertions? And you'll look at these procedures. We're not going to go into too much detail about this right now, but these are all examples of the types of procedures that we perform to test the individual assertions. So how do we know what these procedures are? The answer is we're getting to that, I promise. We've got another long list to go through. But these relates to one another. Once we identify what the assertion is we're concerned with, we need to understand how can we test those assertions? How can we actually validate those assertions are correct? And this is going to be the process that we do this. So we're going to talk about confirmation here in just a little bit. I'm going to try to remember to come back to this slide and say, how is this a test for existence? But right now, you can make a note that it looks like for its existence assertion with respect to accounts receivable, we've decided that we're going to perform a confirmation test. What does that mean? I promise we'll get to that here in just a second. All right, let's talk about evidence at a very general level. So I do want to make a note here, just like management assertions and audit assertions, the terms are interchangeable. When you hear the term assertion in this course, you can understand I'm talking about management assertions. To the same degree, when you hear the term testing or procedures or evidence, those all basically mean the same thing. Auditing has a lot of interchangeable terms. We're actually going to talk about more on Wednesday when we get to documentation. We're going to talk about different terms for documentation. So if you hear me say audit testing or audit procedures or audit evidence, those all mean basically the same thing. They're collectively the same. So audit evidence is the information used by the auditor arriving at conclusions on which the audit opinion is based. So before we get into the nature of evidence, the different types of evidence that we can collect, let's go ahead and talk about three concepts. And I use the term nature loosely because that's actually one of the concepts we need to talk about. We need to talk about the nature of audit evidence, sufficiency, appropriateness of audit evidence, and the evaluation of audit evidence. So these are important concepts. This is not the list of evidence that we're going to be looking at. We're going to be looking at different types of evidence here in just a little bit. But these are concepts. These are all things that evidence has to meet, criteria that evidence has to meet in order to be able to be useful. Now, nature of evidence is a bit of a misnomer because it doesn't really matter how we categorize nature, because it's basically one of two things. When we talk about nature of evidence, we're talking either about counting records, which I'm not going to read this long blurb, but we're talking about basically records that are generated as part of the accounting process. All right. So the first category of nature of evidence we could actually say is accounting records. Very, very general definition. Now, I really feel bad about this second one because this is kind of a throwaway. The next one. Basically, the second category is anything that's not accounting records. Okay. Like that old Mark Twain saying, it's like there's only two times in the life a man shouldn't gamble: when he doesn't have the money and when he does. All right. That's kind of what we got right here, is that we've got accounting records and everything that's not accounting records. That's the nature of evidence right there. Is there a possibility I could ask you a test question on that? There's absolutely a possibility. So remember my silly comment here. So yeah. So anything that doesn't represent accounting records. Now, this seems like a small amount, but the simple truth is that accounting records only represent one type of evidence. There's a wide array of different types of evidence that we can identify that are going to be related to this. So meeting minutes, confirmations, data about competitors, control manuals, blah, 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 audit procedures, inquiry, observation, and inspection. All these things can be different types of evidence we can identify. And these do not necessarily need to be related to accounting records developed by the system or by the organization. So basically, accounting records, everything else. I know, I just wasted like 2 minutes of your life to explaining something that was obvious. I apologize. Next, we're going to talk about sufficiency and appropriateness of audit evidence, okay? So sufficiency is the measure of the quantity of audit evidence. That's all there really is to it. When we talk about whether it's sufficient evidence, they're saying, do we have enough evidence? Is there enough quantity of evidence to merit our opinion? And I didn't really have anything more to say about this, but I hate blank slides, so I just put a meme in here. So yeah, hopefully you enjoyed it. And then we've got a little bit more with appropriateness. Now, sufficiency is quantity. Appropriateness must by definition be quality of evidence. I would argue that appropriateness is probably the more critical of the two terms, but they're both really important. We want to make sure that we have appropriate evidence to justify our conclusions. Now, how do we determine whether something is appropriate? This actually goes back to a question that was asked to you back in the chapter 1 homework where you looked at evidence. And remember, we talked about sufficient appropriate evidence, and appropriateness was measured by relevance and reliability. Relevance and reliability. So the relevance of audit evidence versus relationship to the assertion being tested. If we gather evidence that we're trying to test completeness, we want to make sure that the evidence we're using actually confirms completeness. If we gather evidence on existence, then we're testing the wrong assertion. So to be relevant, it has to be related to the assertion we're concerned about. The reliability of evidence refers to whether or not a particular type of evidence can be relied upon to signal the true state of an assertion. My example for reliability is always going to be whether or not you can validate the evidence, is whether or not whether the evidence represents a high level of validity. So if you can rely upon the piece of information without any additional signals, then you say that's high reliability. If it does require corroboration, which many of our types of evidence do, then it's going to be low reliability. Now, we're going to get to that in a little bit because we do want to talk about which evidence are more reliable than others. There's some that are going to be very useful. They're not necessarily very reliable. Okay. Last concept that we need to talk about is we need to talk about the proper evaluation of evidence. Okay. So a proper evaluation requires the auditor understands what types of evidence are available, which we just talked about the nature of evidence. So that's basically the one category. We can also talk about the different categories we're going to look at here in just a second, which there's 10 of them. And then we also want to know the relative reliability, which we know about already, or diagnosticity of evidence. Now, has anybody ever heard a technical term like diagnosticity? Okay, so what does that mean? What does diagnosticity mean? Okay, basically, it just signals how well the evidence supports a given premise versus an available alternative. So if you look at a piece of evidence and it strongly signals what you believe to be true, then you can kind of assume that that evidence supports that assertion. Now, if you look at a piece of evidence and it signals something else is true, you generally have to throw that piece of evidence, or you have to throw that assumption out. Don't throw the evidence out. My bad. Okay. You know, so throw that assumption out. You say, okay, my assumption about whether something was correct or something was valid here, like this transaction or this area is complete. This evidence seems to promote the fact that it's not complete, that there's completeness violations in this area. So that's what we mean by diagnostic. Now, this is going to be a kind of an important point to note later on in the semester, but I do want to bring it up now because this does relate to something we're going to talk about here actually next week, next Friday. In evaluating evidence, an auditor should be thorough in searching for evidence and unbiased in its evaluation. Now, how many of you have heard the term cognitive biases before? We're going to talk about cognitive biases a little bit next week. We're going to talk about it at a very general conceptual level, but it's really important to note that in this profession, cognitive biases are pervasive. They are really problematic for us to deal with. So we need to know what they are, and we need to know how to deal with them. For right now, though, all we need to know is that this statement is basically saying you are susceptible to cognitive biases. You need to know how to deal with them. Now, how do we deal with them? That's a question that'll be later answered, all right? But being aware of them right now is really, really important. Okay, so remember our phases in audit testing. Let's just refresh ourselves with this, okay? So when we talk about phases in testing, we're not talking about the phases of the audit. So phases of audit start with planning, and they move on all the way to conclusion and then audit reporting, okay? When we talk about phases in testing, we're talking about areas of the audit where we as auditors can gain assurance about the true state of the financial statements. So what was our first phase of audit? It's what we talked about in chapter 4. Does anybody remember? Give me a hint. It starts with a risk. Okay, it ends with the word assessment. Risk assessment. There we go. Risk assessment. Okay, that's going to be our first phase in audit testing. All right. The next phase is going to be one of those things that I alluded to a little bit earlier, but it has to do with those wonderful things that like segregation of duties, those things that I talked about back in AIS. What is that phase? Test of controls. Yes, test of controls. And then we have our final phase where we wrap everything up, which is going to be substantive procedures, which is what we're talking about right now to a lesser degree, but we're going to talk about those in broad detail. Within substantive procedures, there's two subphases, all right? There's going to be substantive analytical procedures and substantive test of details. Now, by the way, by this point within the semester, you're going to need to know all the phases of the audit. Partially because a lot of questions will depend on what phase of the audit you're in. So if you didn't know the list, that's fine. Make sure you go back and refer to some of the things I talked about. So just as a quick reminder, these are the phases in audit testing, which you absolutely need to know, which we'll reinforce many, many times here over the remaining, how many minutes are left in the lecture? 20 minutes! Goodness gracious. All right, out of the remaining 20 minutes. And then we're also going to reinforce them in other parts. But you also need to remember that we start with planning and engagement acceptance, and we conclude with audit conclusion and report issuance, okay? So those are additional phases in the audit. But it's really important to remember those. Those are a big long list. To a lesser extent, you can actually just memorize those. Those don't need to be knowledge because they're fairly self-explanatory. All right, so why is this important? Because what we're about to look at relates to what we're going to be talking about in this slide. We're about to look at a big, long list of evidence. All right. So what do we said? There's different types of evidence we can collect, and these are all, again, these are procedures or testing, however you want to talk about them. All right. What are the types of evidence we're going to be talking about? Well, we've got a list of 10 of them. And technically speaking, it's 8 because 2 of these are kind of a subset of one of the types of evidence. But the first one's pretty straightforward. It's inspection of records and documents. Inspection of records and documents. This is just accounting records. This is where we as auditors look at a client's accounting records. And sometimes we can actually say some external records if those are available, like bank statements, things like that. And we make judgments based on that information. This is going to be very, very flexible for us. It's going to be very, very helpful. So we can actually use this during any phase of the audit. Does anybody remember when I talked about this last Wednesday and I said inspection of records and documents can be used during any phase of the audit? Maybe it was last Monday. It's been a while. Yeah. So inspection of records and documents can be used during any phase of the audit. And it actually tests a lot of assertions. I believe it can test all assertions. We also note there's 2 sub-phases of this, okay? Or 2 subversions of the evidence, I should say. There's vouching and tracing. Now, the reason I mention these are inspections of records and documents that test specific assertions. Vouching tests existence completeness, existence occurrence. Goodness gracious, I'm off today. Existence occurrence. Tracing tests completeness. Now, basically what that means is that we use certain specific tests in sequence to go in a certain direction to make sure we can verify assertions. Now, does anyone remember what the direction I told you about when I said completeness? What did I say the direction was? Bottom to top, and then I said existence occurrence was top to bottom. There's actually a very clever way to remember this. If you remember that vouching relates to existence occurrence and tracing relates to completeness, and this is not my idea, this is Becker, but this is my image. I created this myself, and I'm very proud of it. Vouching's got an arrow pointing down, top to bottom. Okay, tracing's got an arrow pointing up, bottom to top. Okay, isn't that great? Makes things so much easier. But you do have to remember that vouching is going to test existence occurrence. Tracing is going to test completeness. By the way, I don't want to waste a lot of time on this, but please make a note. Always validate when we talk about vouching and tracing. Always validate that they relate to truth, that truly relate to the assertion. Which we'll get more experience with that. But tracing is a much more common word in the English vernacular than vouching. And oftentimes people will say the word tracing when they really mean vouching. The book has done that a few times. They've gotten better about it, but sometimes they will do that. They will say tracing when they don't mean tracing. So make sure that you're looking at the proper direction whenever you're looking at it. You can't just take it at face value. Unless it's on one of my exams, I will always give you the correct direction. All right, next one. Inspection of tangible assets. Inspection of tangible assets is a very potent test. It's where we go when we look at a tangible asset. Usually we're talking about a large asset like a piece of equipment or land or something like that. We can look at it. We can validate it's there. We can say, yeah, look, we just inspected it. Very, very powerful test, very highly reliable, but it only tests one assertion. It only tests existence occurrence. Okay. Next is observation and to a lesser extent, inquiry. Observation and inquiry are considered to be oral assertions where we actually observe something or we get information from another individual. Observation and inquiry we've already talked about. We talked about those as being tests of controls. Those are kind of tests that we can operate during risk assessment. They're very flexible in that they can be used during any phase of the audit, but they're extremely low reliability. Why might they be a low reliability? Well, let's take inquiry as an example. Let's say you go talk to management to understand our procedures working, and the manager says he might find the fraud that I'm promoting here. Could they possibly lie to you about something that's going on? I know it's hard to believe, but in the past, management has lied about things. It's true. Observation is the same thing. If you're observing somebody doing a task, they may do it differently if they're trying to disguise their actions. So observation and inquiry, low reliability, but they're very, very flexible and they test multiple assertions. Confirmation. Confirmation, yes.
So which one does inspection of tangible assets test? Which assertion?
Existence occurrence. And by the way, I will have a cheat sheet for you, but I'll share that with you here after we get through that. So, all right. Confirmation. Confirmation is a third-party request. That's basically an external party to the entity that we're requesting information from. Oftentimes we can use this to test account balances. In fact, I do want to make a note of this because this will always come up and it will absolutely be on the exam, okay, in some form or fashion. When I say confirmation is a test of account balances, that means that it cannot be used as a test of controls. Because remember earlier we were talking about controls relate to transactions and events. You can't use confirmation to test transaction events. Only you can use controls. Now, you may go out in the real world and somebody would say, hey, I can use a confirmation for a test of controls in this case. As far as this room and this class goes, this course goes, I want you to write down this one absolute. Confirmation will never be used as a test of controls. Now, it seems like I'm emphasizing that. I put this on multiple exams, and I always have students that are after the fact like, oh, because they forget. Confirmation can never be used as a test of controls. All right, don't forget that. If there's one thing I want you to remember, no, actually, I want you to remember it for the exam. Never mind. Okay. Recalculation. Recalculation is just as it sounds. It's the auditor recalculating numbers provided or prepared by the entity. Very, very potent test, but it only tests one assertion. Can anybody guess which one it is? Math, so it's going to be VAA. Yeah, very good. VAA. Reperformance. Reperformance is actually another high performance test. It's where an auditor reperforms the task performed by the entity to get the same results. If we get the same results, that gives us high validation. It's important to note that reperformance is almost always used as a test of controls, but almost always is not the same as always. It can also be used as a substantive test as well. Okay. Then we have our final one, which is analytical procedures. For right now, I just want you to know that analytical procedures is developing an expectation or looking at trends in data. We're going to go into much more depth about analytical procedures on Wednesday, so you will have a better definition of those. But I want you to, right now, it's basically developing a trend or identifying a trend or developing an expectation. Okay. So a few things that we need to know. First of all, the most important thing you need to know about this evidence that we're looking at right here is how this evidence relates to assertions. Remember earlier I said inspection of intangible assets is a great test. It's highly reliable, but it only tests one assertion. That means if I want to verify the completeness of a fixed asset, I can't use inspection of tangible assets because that does not test existence. And it makes sense because remember, completeness is saying I know something exists. Is it in the system? Is it in the records? Going and looking at a building standing that's been constructed doesn't actually validate whether it's in the system. So some of these types of evidence are limited. Some of these are very, very broad in what they can do. So I know everybody's dying to ask, well, Dr. Barnes, how do we know which types of evidence relate to which type of assertions? The answer is I created a file for you, okay? If you go into Brightspace, one of the files that's on Brightspace is this spreadsheet called Audit Assertions, Audit Evidence. And you will notice that we've got all the different types of evidence over here, and then it explains which assertion is going to be related to. And now you're saying, do we really need to know all that? What do you think the answer is? Yes, yes, you do. Absolutely. Now, the good news is we've got a little bit of time. Also, we're going to reinforce this on Wednesday. This is actually part of the assignment for the discussion on Wednesday. Every single one of you has been assigned to one of these types of evidence, and you're going to have to tell me what phases of the audit you can be used in, what's the reliability level, and what are the assertions. So you also notice the reliability levels here. I'm going to get to that, to why they're different level of reliability and the easy way to remember that, okay? But I do want to go back. Go back. So remember, we have our phases of the audit. Which types of evidence can we use during which phases? We've already talked about risk assessment, but let's reiterate. Remember, 3 types of evidence can be used during any phase of the audit. What are those 3 types of evidence? Inspection of records and documents, observation, inquiry. Those can be used during any phase of the audit. Does anybody remember the 4th from last week we talked about it? It's analytical procedures, specifically preliminary analytical procedures, which again, we're getting into more detail about what that means on Wednesday, but right now you just need to remember that those 4 types of evidence can be used during this phase of the audit. All right, test of controls. There are 4, technically 5, but I'll explain that here in a second. 4 types of evidence that can be used during test of controls. I bet you can name 3 of them. Nope. I'm going to name 3 of them. Inspection records, documents, observation, inquiry. You know why? Because they can be used during any phase of the audit. Inspection records, documents, observation, inquiry. The 4th, I actually mentioned when I was going through the evidence. I said, this type of evidence is almost exclusively used as a test of controls. Does anybody remember which one I was talking about? Reperformance, okay? Reperformance is our 4th. I want to mention a 5th, and this is going to be really confusing. A 5th one is actually technically in there. It's called walkthroughs. And you may look at the evidence and say, Dr. Barnes, that's not in your list of evidence. And I say, you're right. Good identification. Good identification. The reason why is a walkthrough is basically a fancy term for a combination of all the previous types of evidence. Okay? So they do include this in the auditing standards as a type of evidence, which is why it's confusing. But a walkthrough is basically just a fancy amalgamation of all those. All right. Substantive procedures are easy. The substantive procedures are easy. For substantive analytic procedures, we can only gather one type of evidence, and I bet you can guess which one it is. So for substantive analytical procedures, hold on, let me say this differently. For substantive analytical procedures, we can only gather one type of evidence. Which type do you think it is? Inspection records documents. No, it's analytical procedures. Analytical procedures. Yeah, very good. Okay. For substantive tested details, it's everything else. Okay. All of the other types of evidence can be gathered during tested details, which is why substantive procedures, we can use any type of audit procedures, any types of evidence gathering. So the difficult ones to know are the ones up here because these only have a limited number, but they all use down here. All right, moving forward. So with respect to reliability, one thing that we need to note is what gauges whether something is more reliable or not. And the answer is, how much does the auditor have responsibility for the generation of that evidence? Okay. Remember I said inspection of records of documents, reperformance, recalculation, those are all high reliability forms of evidence. By definition, the auditor performs all of those tasks. The auditor does the recalculations. The auditor reperforms the client's tasks. They inspect them themselves, which is why they're high reliability. On the opposite end of the spectrum, if we have to rely on information from the client and that's our sole reference, those are low reliability. Observation and inquiry. Observation, I watch something, somebody could say, oh, he's watching, I better do something different. Inquiry, oh, he's asking me questions, I should lie to him. Those two types of evidence are very, very versatile, but they're also very low in reliability. By that definition, when we as auditors use these types of evidence, we generally have to corroborate those types of evidence with other more powerful pieces of information or evidence. By the way, there's actually an acronym, or sorry, not an acronym, it's not an acronym, I don't know what you call it, a mnemonic, yeah, that Becker uses that I really like up until the last letter, all right? So it's AEIOU for this. Highest reliability is auditor-generated evidence, A. Medium reliability is external evidence, then internal evidence. So external would be like evidence from third parties. Internal evidence would be stuff from their client. O is oral evidence, which is observation and inquiry. And you say, what's the U, Dr. Barnes? And they actually say, you know it. It's so cheesy. It's so cheesy. That's what Becker does. That's what Becker does, okay? So AEIOU, if you want to remember it that way, that's a good way to remember it. All right. So what are we moving forward to? So we're going to be talking about, after the exam, we're going to be talking about test of controls, which is technically speaking the next step in their testing. Basically, once we gain enough assurance in test of controls, we identify what work we have to conclude the audit. Because remember, the controls are created by the client. And if controls are effective, they may reduce the amount of work that we have to do as auditors. If they're not effective, then we have to do more work, which is why we generally perform these first. Not always, but generally perform those first. That's going to dictate what we have to do to conclude. Generally, we'll start with analytical procedures, which will make more sense why we use analytical procedures first. And then everything else that we have to do to gain a certain amount of assurance, we're going to conclude with. By the way, has anybody paid attention to me using this word assurance? Is anybody be confused? Like, what does he mean by assurance? At a general level, when I use the term assurance, I'm trying to say, this is enough information for me to be satisfied with my conclusion that I've rendered, all right? Now, quantitatively speaking, could we think about this differently? And the book says yes, all right? The book actually uses something called the assurance bucket analogy, which is not a bad analogy. It's not a bad analogy. If we think about it, we think that within certain areas, okay, certain areas of assertions with respect to a particular context, we need to gain assurance. So let's just say that we've got one type of area, let's say inventory. And for inventory, we're concerned about completeness, accuracy, cutoff, presentation, disclosure, existence, occurrence, valuation, rights, obligations. So all the irrelevant assertions. You notice authorization is not up there, and thank God. All right. So we want to gain information about all these assertions, and we gather evidence during each of these phases of the audit. Now, what were the phases again that we get tested? We do testing. It's going to be risk assessment, test of controls, substantive analytical procedures, substantive tested details. And you'll notice we first pour into the assurance bucket these risk assessment procedures, which you gain some assurance about. Then we get some more from tested controls. Then we get some from substantive analytical procedures. Then the remaining gets from tested details. All right. Now, what does this imply? It implies that if I get more assurance from these lower level tests, how much assurance do I need from these higher level tests? Minimal, okay? Generally speaking, test of controls will not fill the bucket, okay? That's something that we're going to note. Test of controls will never fill the bucket completely. We still have to perform some substantive analytical procedures, or substantive procedures, not analytical procedures. some substantive procedures. Even if we have a really strong analytical procedure, we may not get all the way. Sometimes we can bypass testing. We'll talk about when that might occur. But for the most part, some sort of substantive procedure must be performed to get to the full bucket. All right. So what about if we have less assurance down here? Like if I get minimal assurance from my risk assessment and my test of controls give me like 5%, what does that tell us about our substantive procedures? We have to do more. We have to do more to fill the bucket, okay? Because we're trying to get to a certain level. Now, judging from your state, I can tell you that this assurance bucket analogy is not making very enthusiastic. I see a lot of people just with kind of blank looks on their faces says, this is the most boring thing I've ever had. It's like, welcome to my life. All right. So I want to spice this up a little bit, okay? Spice this up since we're really close to lunchtime. And if you may be hungry, if you're not, maybe this will make you hungry. But this is what I call the Chipotle burrito analogy, okay? Has anybody eat Chipotle before? Okay. Has anybody had a burrito from Chipotle before? It's been a long time for me because we don't have it in Kirksville, so it's time I don't get to go out very often. But when you get a burrito Chipotle, they put down the massive tortilla, which tortillas are fairly cheap, so it's not that big a deal, that massive tortilla, or whatever the wrap is. And then what is the very first thing they try to put on your burrito? They put on rice, like roughly a metric ton. Okay. Like put a metric ton of rice on there. And then they take tweezers and they put all your ingredients on it. And also like, so here's your burrito. It's like, okay, thank you for the rice. All right. I want to know, first of all, who thought of this, because every burrito I'd ever eaten before Chipotle did not have rice on it. I'm not saying it's bad. I'm just saying it just doesn't seem to belong. Okay. But what's the rationale? What's Chipotle's rationale for putting the rice on there? It's cheaper. If they fill the burrito with volume of something that's cheap, they don't have to fill the burrito with something that's more. So it's like they're like the auditors. They're saying, okay, if we can get our assurance through the rice, then we don't need to put assurance in there through the chicken and the guac and the cheese and the salsa and all the good stuff. Okay. Now, has anybody ever requested a burrito without rice on it? I did one time. It's a horrific experience. Okay. Everybody turned in the restaurants and stared at me. It was like the Night of the Living Dead. It was just really, really, actually, it wasn't quite that bad. But I literally had to say, I don't want any rice on it like 3 times because they kept trying to put rice on it. And so what does that mean when they put rice on it? Because they're trying to defer some of their costs to that rice. That rice actually fills the burrito. It makes it look big. But instead, you ask that, so they got to put the good stuff on there. You got to put all the protein, and they got to put all the good veggies and the queso. I mean, queso. Yeah. So what happens then? The cost, there's a higher cost to them. That's like doing additional substantive procedures. Okay. They didn't fill the burrito early on with the cheap stuff. So now they've got to do the expensive stuff to fill it up to get it to the point where it's got to be. All right. So that's the way that I like to think about it. Now, is this actually a more compelling analogy for the assurance bucket? It's definitely more interesting. Okay. I don't know if you learned anything from it, but that's the way I like to think about it. Okay. If you get more assurance early on through doing the easy stuff, then you can save yourself the hard work later on. All right. Same idea. All right. We are done with today. Steve, please make sure you're prepared for your discussion. You've been assigned to one of the types of evidence. You need to be able to answer all 3 questions that I identified. Refer to that Excel file. That will help you a massive amount in your preparation. Right there.